Picture the problem the way every economics textbook does. You're a baker. You have bread, you want shoes. So you find the shoemaker. But today, he doesn't want bread. So you go looking for someone who has what he wants and wants what you have. And you keep looking. It's chaos, hopelessly inefficient. And so, the story goes, humanity invented a tool to end the madness. Money. One thing everyone would accept. Barter became coins. Coins became paper. Paper became the numbers on your screen. Clean. Logical. The obvious next step in human progress. It's a beautiful theory. Adam Smith wrote it down in 1776. We've taught it for 250 years. There's just one problem. No one has ever found it. Not in the archaeological record, not in any study of any pre-modern society on Earth. The barter economy that supposedly gave birth to money, the founding scene of economics itself, appears to have never existed. Because 5,000 years ago, in the river valleys of Mesopotamia, a scribe pressed a stylus into wet clay and baked it in the sun. It wasn't poetry. It wasn't a prayer. It was a receipt. X owes Y 3 bushels of barley. Before coins, before paper, before barter, there was a ledger. We didn't invent writing to record our souls. We invented it to keep a balance sheet. And the thing that came first, before money, before markets, wasn't trade. It was debt. This is the story of the most powerful invention in human history. It's also a 6,000-year-old argument that economists are still, right now, in the middle of having. In 1985, Cambridge anthropology professor Caroline Humphrey published a paper called Barter and Economic Disintegration in the journal Man, published by the Royal Anthropological Institute. Her conclusion challenged one of economics' founding assumptions. No example of a barter economy, pure and simple, has ever been described, let alone the emergence of money from it. The barter origin story doesn't appear in the archaeological record or in any anthropological study of pre-modern societies. The claim is still debated by economists, but the foundational story Adam Smith told in The Wealth of Nations may have the sequence backwards. And here's the crucial point about Smith. His baker and shoemaker world was a brilliant thought experiment, but that's all it was. He had no archaeological evidence for it. He projected the logic of an 18th century British marketplace backward onto ancient humans who operated on an entirely different footing. The sequence the evidence actually supports? Credit came first, then money, then barter, which typically only shows up when monetary systems collapse. Understanding this reversal changes how we see the modern economy, the $323 trillion in global debt sitting on the world's books right now, and the question of whether this system is a triumph of human ingenuity or a slow-motion catastrophe 6 millennia in the making. So let's go back to the beginning. Not the mythical beginning, but the real one. Around 3,500 BCE, in the river valleys of southern Mesopotamia, the Sumerian civilization developed something extraordinary. Not money, not coins. Those wouldn't appear for another 3,000 years. What they developed were records of debt. About 500,000 cuneiform tablets have survived to the present day, and a staggering number of them are essentially IOUs, loan contracts, wage records, and accounting ledgers. Assyriologists who study these tablets point out that these early administrative records, payrolls, rations, receipts, were among humanity's first steps toward a full writing system. Think about that for a moment. We didn't invent writing to record poetry or prayers or the names of kings. We invented writing to keep track of who owed what to whom. The very foundation of human literacy, the technology that separates prehistory from history, exists because of debt. By around 3000 BCE, the Sumerians had developed sophisticated methods to handle loans, deposits, and trade, all recorded meticulously in cuneiform. These weren't primitive scratch marks, they were complex financial instruments. Temple and palace administrators acted as early bankers, managing grain deposits, issuing credit, and charging interest. And here's one of the most remarkable etymological details in all of economic history. The Sumerian word for interest was mas. It also meant calves. The logic was elegant. If you lend someone a herd of cattle, that herd will naturally multiply over time. Calves will be born. So when they return your herd, shouldn't you get back more than you gave? The ancient Greeks had a parallel. Their word for interest was tokos, which also meant the offspring of cattle. Interest wasn't an abstract financial concept. It was modeled on biological reproduction. Money, like livestock, was expected to breed. But from the very beginning, debt carried a danger that the Sumerians understood with remarkable clarity. Debt grows exponentially through compound interest. Harvests don't. Economies don't. Human productivity doesn't. And when the gap between what people owe and what they can produce becomes too wide, societies fracture. The Sumerian response to this problem was one of the most radical economic policies in human history, and one we've almost entirely forgotten. They canceled the debts. Not occasionally, routinely. Historians have identified with confidence about 30 general debt cancellations in Mesopotamia between 2400 and 1400 BCE. These weren't acts of charity, they were acts of statecraft. When a new king took the throne, one of his first moves was often to declare a clean slate, wiping out personal debts, freeing debt bondage victims, and restoring land that had been seized by creditors. The first word for freedom in any known human language was the Sumerian word amarji, also written amagi. It literally means return to mother. It referred to debt slaves being freed to return to their families. Freedom, in its original conception, wasn't an abstract philosophical ideal. It was liberation from debt. Hammurabi, the Babylonian king who ruled from 1792 to 1750 BCE, enacted 4 general debt cancellations during his reign alone, in 1792, 1780, 1771, and 1762 BCE. His famous legal code, one of the oldest written laws in existence, declared that the powerful may not oppress the weak, and that the law must protect widows and orphans. The code regulated wages down to specific occupations. A rope maker earned 4 gerahs per day. A tailor earned 5. These weren't suggestions, they were law. Michael Hudson, the economist who spent 40 years collaborating with Harvard's Peabody Museum documenting Bronze Age financial systems, puts the ancient insight bluntly. The burden of debt tends to expand to the point where it exceeds the ability of debtors to pay. And that, he argues, has been a major cause of economic polarization from antiquity to modern times. The ancients knew this. They built mechanisms to prevent it. And then, gradually, those mechanisms disappeared. By around 600 BCE, something new appeared: coinage. For the first time, debt was being denominated not in grain or cattle, but in standardized metal discs issued by governments. David Graeber, the anthropologist who wrote Debt, the First 5,000 Years, identified what he called the military coinage slave complex that emerged during the Axial Age. Empires required standardized coins to pay their standing armies. These armies expanded imperial borders, bringing new populations under state control. To enforce the system, the state demanded that these newly acquired territories pay taxes exclusively in government coin. How did the locals get those coins? By selling goods, crops, or labor right back to the occupying soldiers. The currency flowed in a perfect loop, from the state treasury to the military to the populace and back to the tax collector. Money, state power, and military expansion became completely inextricable.
Graeber,
a professor at the London School of Economics and one of the original organizers of Occupy Wall Street, argued that nothing justifies violence more effectively than reframing it in the language of debt, because it makes the victim look like the one who did something wrong. That insight connects directly to one of Hudson's most striking findings about the intersection of debt and religion. In a near consensus among Assyriologists and biblical scholars, the Bible is preoccupied with debt, not sin. The original Lord's Prayer didn't ask God to forgive us our trespasses. It used the Greek word ophilemata, which literally means financial debts and legal monetary obligations. The prayer explicitly asked God to forgive us our debts as we forgive our debtors. The word was later changed, depending on the translation, to trespasses or sins, moralizing what was originally a structural economic problem. But the original meaning was strictly financial. Forgive what we owe. Release us from our balance sheets. Return us to Mother. Now, fast forward about 2,000 years to 17th century London, where a seemingly innocent practice laid the foundation for the financial system we live under today. Wealthy merchants needed somewhere to store their gold. The goldsmiths of London had secure vaults, so merchants began depositing their gold with them for safekeeping. The goldsmiths issued paper receipts, and before long, people started trading these receipts instead of the gold itself. Why haul heavy metal around when a piece of paper would do? Then, as the popular story goes, the goldsmiths noticed something. Not everyone came for their gold at the same time. Most of it just sat in the vault. So they started lending it out, collecting interest on gold that wasn't even theirs, and they issued more receipts than they had gold to back them up. This is the origin usually given for fractional reserve banking, the system upon which virtually every modern bank operates. The goldsmiths had discovered that they could create money through the issuance of credit, as long as everyone didn't show up to collect at once. This created a new kind of money that was actually debt. Not silver or gold coin, but goldsmiths' promises to pay, circulating as currency. Over the following century, formal institutions hardened the practice into architecture: the Bank of Amsterdam, the world's first central banks, and the Bank of England's banknotes, each one a further step away from anything you could hold in your hand. In 1913, the United States established the Federal Reserve System. In 1944, the Bretton Woods Agreement pegged the world's currencies to the US dollar, which was itself pegged to gold at $35 an ounce. For a quarter century, this system provided remarkable stability. But it also contained a contradiction. The US was printing more dollars than it had gold to back. Then came August 15, 1971. President Richard Nixon, advised by Federal Reserve Chairman Arthur Burns and Treasury officials, including Paul Volcker, unilaterally canceled the direct international convertibility of the US dollar to gold. The Nixon shock, as it came to be known, didn't just change monetary policy. It ended the last vestige of the idea that money represented something real, something physical, something finite. Volcker himself later reflected that once the British moved to take gold for their dollars, it was clear the game was over. By 1973, floating exchange rates had replaced Bretton Woods for global currencies. Money was now entirely fiat, backed by nothing except the full faith and credit of issuing governments. Some economists call this liberation, the necessary flexibility that allows modern economies to grow and adapt. Adherents of the Austrian school call it something else entirely: the crime of 71, the final nail in the coffin of sound money. Meanwhile, proponents of modern monetary theory argue that fiat currency actually frees governments from artificial fiscal constraints, allowing them to serve public purpose more effectively. Regardless of where you fall on that economic debate, the modern consequences are no longer just abstract numbers on a screen. They are actively reshaping human geography. Today, we have reached a bizarre historical tipping point. Dozens of developed nations now spend more tax revenue just paying the interest on their past debts than they do on their national defense. But the true weight of this system falls on the developing world. Right now, nearly 3.5 billion people, almost half the population of this planet, live in nations forced to pay more to foreign creditors in interest than they are able to spend on the healthcare or education of their own citizens. Wealth is flowing backward. In recent years, developing nations paid out far more to external creditors than they received in new financing, a massive, silent extraction of resources. Even inside the corporate world, much of the money being borrowed isn't going toward building factories, funding research, or raising wages. A large share is funneled into stock buybacks and shareholder payouts. Debt is no longer funding the future. Increasingly, debt is simply feeding debt. In March of 2020, the Federal Reserve quietly shifted the mechanics of modern banking by amending Regulation D. It lowered the statutory reserve requirement ratios for all depository institutions to exactly 0%. This completed a structural transition away from traditional fractional reserve constraints into what economists call an ample reserves framework. Under this model, commercial banks are no longer bound by a fixed ratio of cash reserves to deposits. The historical mathematical baseline of banking has been replaced by a system driven by liquidity management and credit creation. The old ledger limits are gone. The loop now runs on balance sheets and credit expansion. So here we are, 6,000 years after Sumerian scribes pressed the first debt records into wet clay. We've built a global civilization that runs on obligation. The numbers are almost incomprehensibly large. The complexity is staggering. And the fundamental dynamic the ancient Mesopotamians understood, that debt grows faster than the ability to repay it, remains unchanged. Hudson states it with the simplicity of someone who has studied this pattern for 4 decades. Debts that can't be paid won't be. The great political question is, how won't they be paid? So let's run the ultimate modern thought experiment. What if we actually did what the ancient Sumerians did? What if a global leader stepped forward tomorrow and declared a total, uncompromised modern jubilee? Imagine it. Every credit card balance wiped clean. Every student loan erased. Every mortgage deleted. Every national debt brought back to zero. For a few hours, there would be dancing in the streets. But within days, the illusion would fracture. Because unlike ancient Sumer, where wealth was real grain sitting in a physical temple silo, our modern wealth is the debt. The global banking system wouldn't just reboot, it would vanish instantly. Pensions, savings, the entire digital infrastructure of modern commerce would dissolve. And that is the terrifying mathematical trap we've built. In ancient Sumer, the answer was jubilee. Debts were canceled, slaves were freed, land was returned. Society hit the reset button, not out of compassion, but out of the pragmatic recognition that the alternative was collapse. Today, we have no equivalent mechanism. No jubilee, no clean slate. Instead, we have an ever-expanding architecture of refinancing, restructuring, and rolling over, pushing the question forward, compounding it, hoping growth will somehow outpace the mathematics of exponential obligation. Now, to be fair to the other side, the economists who defend the textbook story aren't fools, and they have a real rebuttal. They argue that even if no pure barter economy ever existed, money still solved a genuine coordination problem, and that the credit systems of ancient temples were themselves a kind of accounting that markets eventually formalized. The honest answer is that the debate isn't fully settled, and anyone who tells you it is selling something. But here's what's hard to dispute. The story of debt is the story of civilization itself. Writing was invented to record it. The first concept of freedom was liberation from it. Religions were organized around its moral framework. Empires rose and fell based on how they managed it. And the modern global economy, all $323 trillion of its interlocking obligations, is the latest chapter in a story that stretches back to the clay tablets of Sumer. Whether you see this system as humanity's greatest innovation or its most elaborate trap may depend on which side of the ledger you sit on. The Sumerians understood something we've chosen to forget. When debts become unpayable, you have two real options. You can forgive them, or you can watch the system break. 6,000 years of evidence suggests we're still choosing between the same two, and mostly pretending there's a third.